In this video, you will learn the market's dilemma theory by Jake Twentysvn. You will know what any of this means, learn a simple strategy, and also be ready to create your own strategies that suit your style. There are two main important arrows that help us explain this theory. We have the green arrow for loyalty and a red one for betrayal. We'll get to what this means in a second. First, let's have a Euro USD chart, just the mock chart, and let's say the market is here at this point in time. And the theory is, at any point in time, the market is faced with a dilemma. It can either go up or go down. It is faced with a choice. The market can either go up or can go down. And in this instant, it chose to go down, or it was forced to go down. There are many factors that influence the market's decision to either go up or go down. And even here, the market is still faced with the decision. Should I go up or should I go down? And all the way back, the market was faced with these choices of going up and down. Our main goal as traders or investors is to try and know which decision the market is most likely to take next. And these decisions are influenced by economic factors such as inflation, interest rates, government policies, or price action patterns such as old low and highs, liquidity, support, and resistance. Traditional strategies are based on these factors as traders try to look at them and anticipate the next move. While this sounds like a logic thing to do, 90% of traders lose their money trading this way. My take is that there's so many factors at play that are ever changing that it's so hard to actually form a strategy out of that. And that is why we are going to avoid all these and try to form our own strategies using loyalty and betrayal. So let's get to what loyalty and betrayal mean. Say the market is at this point and is faced with a dilemma. Should it go up or should it go down? At this point, it goes up. And we have another move up. Now this move was loyal to this move. This move was up, and this one also continued going up. So this move gives us the arrow of loyalty. And if we have another move up, we have another move of loyalty. This move was loyal to this move. And it can go vice versa. If the market was to go down, there was a move down, and then this move was loyal to this one. This one was loyal to this middle arrow. Now let's say there was a move up and then a move down. Now this is an opposing move. This gives us the arrow of betrayal. The market, this move betrayed this one, our arrow of betrayal. Should they have a move up, we have another arrow of betrayal because this move up betrayed this move down, just like this move down betrayed this move up. And we can say that the market is comprised of these arrows of loyalty and arrows of betrayal. Okay, let me say clusters of loyalty and clusters of betrayal, because if the market was only comprised of arrows of loyalty, it would just go up indefinitely or go down indefinitely. And if it was comprised of these arrows of betrayal, it would just go sideways indefinitely. So a balanced market is made up of clusters of betrayal and clusters of loyalty balanced all together. Okay, continuing on this one, if we were to have a move up, can you tell if this would be a move of loyalty or a move of betrayal? It will be a move of loyalty because we have a move up that is supporting this move up. Therefore, we have our green arrow of loyalty. This is what a loyalty cluster would look like. We have so many errors of loyalty and very few of betrayal. This is what a cluster of betrayal would look like. We have so many betrayals. And this is what a balanced market comprised of these two clusters would look like. Here we have a cluster of loyalty and then betrayal here. And overall, it gives us this balanced market. And with that, you may be asking, how do these errors of loyalty and betrayal and even their clusters help us? Well, if we were to know which cluster we are in, it will help us make a strategy that can better utilize that market condition. There isn't a way for sure to know which cluster we are in, since the market is, how the market is. But with the way we see the market now, there is a way we can slightly be able to tell which cluster we are in. First of all, we can say if we see more green than red, it means we are most likely in a loyal phase. And if we see more red than green, then the market is most likely in a betrayal phase. But there are other factors as well that can help us determine whether we are in a loyal phase or a betrayal phase, such as time, time zone, and period. Time would be maybe the market open, which would open for the time zone, and also a period, which would be the daily time frame to the monthly time frame time period. We have news events, we have liquidity, we have historic events such as past levels of interest, like past lows, past highs. Me personally, I like to check the time and the time zone in which we are trading at. I like to check also news events and avoid them because most of my trades are stop trades. And if there are news events happening, my trades will, my stop losses will not get hit, will get slipped, or even my entries will get slipped. And I wouldn't like that. Liquidity can also be a great indicator, but then I don't concern myself with this because it's usually too complicated for me to understand. And it comes with an overwhelming dilemma of which liquidity is valid. Is the market going to go there first? Is the market? So I usually do not concern myself with this, as well as historic events, because which low is going to hold? There are so many. I don't know if you understand, but then there are so many things at play with this too that you don't know which one is the right one. Give two traders the same chart to analyze. They're gonna come with two different analyses that seem valid. So now which analysis is valid for those two? So I do not concern myself with these two. And usually I like to form my strategies on the loyal phase. Because here's the thing about the loyal phase. If you zoom in here on this arrow, you'll find a loyal phase in here, a micro mini loyal phase in here, and only a little betrayal here, a little betrayal here. That's if you zoom in here. And with that, I think you are ready to learn the first simple strategy we can use. And now the fun part. To form the strategy, we need a basis. So we can say, if we see two arrows in the same direction, then that is a sign of loyalty. Remember, I said I like to base my strategies off of the loyalty phase because it's much easier than dealing with the phase of betrayal. So, if we see two arrows in the same direction, then that is an indication we are most likely in the loyalty phase, and we can look for opportunities. Secondly, take a 1:1 trade on third arrow. 1:1, that is your risk to reward ratio, meaning if you are standing to win $2, you would be risking $2. And the final rule of the strategy is rest and avoid red. What this means is we're only going to take one trade per leg. By leg, I mean one major move up or one major move down before the market takes a breath and rests. The market rests in the betrayal phase. Remember, we said the market is made up of a balance between the loyal phase and the betrayal phase. So we know at some point the market has to pull back and take a breath. With that, before the market rests, we are only going to take one trade. It doesn't matter if we lose the trade or win the trade. Say we lose the trade, we're not going to look for another trade on the same leg. We're going to wait for the market to rest, and then after that, we can look for more opportunities there. So based on these three rules, let's take some trades. Here we have an arrow up, another arrow up, sign of loyalty. So we take a trade here, stop loss here, and take profit here. Remember, at this point, we don't know yet what's going to happen on the right hand side of the chart. So we're just going to pretend like we don't know what's going to happen on this side. An arrow up followed by another arrow up, sign of loyalty. Our trade is taken. And as you can see, we lose this one. All right, let's move. Here, the market rests. Therefore, we can look for more opportunities after this. So it's betrayal, betrayal, two arrows in the same direction. We take our trade here, our take profit, our stop loss, and let's see how this one plays out. We win this one. We win our first trade. The market here goes into a phase of betrayal, so it's resting. We can look for more opportunities after this. So here, two arrows in the same direction. We take our trade here, our take profit here, and our stop loss here. And this one wins as well. So we can take another trade here. As you can see, we have two arrows in the same direction. It's actually even more than two arrows in the same direction. So we are for sure in the phase of loyalty. But we don't take a trade here because remember the third rule, rest and avoid red. So we're going to wait for the market to rest first, then we can look for more trades. The market here betrays again, two arrows in the same direction. So we take another trade here, our take profit here, and our stop loss here. We win this one as well. The market betrays here. This is a sign of resting. And then two arrows in the same direction again. So we take a trade here, a stop loss here, and a take profit here. And we win this one as well. So out of 5 trades, we lost 1 and won 4, giving us an 80% win ratio. Now I know these were mock trades, and also the statistics is not enough to make a conclusion about the winning rate of the strategy. But then here's the thing, you don't need an 80% on the strategy. You just need 51%. You just need 52%. In fact, I can say this strategy can comfortably give you 60%, which is more than enough. Why? Because we are protected by chance. See, we take a 1:1 trade, meaning when we place the trade, we have 50% chances of winning and 50% chances of losing. And all we have to do is come up with the extra 10%. So if you're having a 60% win rate, you would be winning 3 trades and losing 2 trades out of 5 trades, giving you a net +1 per 5 trades you're taking. Let's do some simple math before we move on to the chart. Let's say you take 5 trades in a week. Some days you're going to take 2 trades or more. Some days you're not going to take any trade at all, especially on Fridays whereby there are news events. So let's say you take an average of 5 trades in a week. A month has like 4 weeks. And if you're risking 3% of your account, you would make 12% in a month. Now for most traders out there, it seems like a small amount. But 12% with a $10,000 account, that is $1,200 in a month. With a $100,000 account, that is $12,000 in a month. So that's a lot. I think in a year we are beating Larry Williams. And this is just on your main account. You can have an account whereby you're risking 6%. I will make a separate video of how much one should risk per trade using the Kelly criterion as an indicator, as a guide. Now let's move into the charts and see how this looks like. The first thing to do when you have your chart is to plot your intervals. These are horizontal lines that help us determine the size of our arrows. You can use a fib to help you plot or use horizontal lines on the settings. You can choose any size you feel comfortable with, so they can be like this or they can be like this. Remember, the smaller your interval, it means you'll be taking short-term trades, and the larger your interval, you'll be taking longer trades, but then it mostly depends on the volatility of the market. And on this chart, this is what the strategy would look like. The blue dashes are where I entered trades. Some of them won, some of them lost. The ones that won are indicated by the +1. The ones that I lost, -1. In fact, on this chart, I took a total of 9 trades. I lost 5 and I won 4, giving me a total of -1. Now, if you notice something, most of the trades that I lost are in one cluster of betrayal, and not even the last rule of rest and avoid red could save me this time. But then I will make a separate video focusing on the strategy, and I will show you how you can avoid this. And on this other chart, I took a total of 7 trades, I won 5 and I lost 2, giving me +3. And if you're watching these charts and you feel like you still don't understand anything, do not worry. I will make a separate video focusing on the strategy, going deeper with the rules, and backtesting for hours. But then as for today, thank you for watching. I hope you make really creative strategies from this, and I will see you in the next one.